Then there's the question of lifestyle. Not all tax strategies are financial instruments. Sometimes, simple lifestyle adjustments create long-term benefits. For example, downsizing a home can reduce property taxes, utility costs, and maintenance expenses. Selling a larger house and moving into a smaller, tax-friendly community not only frees up cash, but also lowers the income needed each year. Lower income means lower taxable thresholds, which in turn means less tax on Social Security and other benefits. It's a chain reaction, all starting with a practical choice. Think of Robert, a retired engineer from New Jersey. He raised his family in a big suburban home. But once retirement arrived, the house felt oversized and costly. Robert sold it, moved to a modest home in Pennsylvania, and used the leftover equity to strengthen his savings. His annual expenses dropped, his taxable income lowered, and he discovered that his Social Security remained largely untaxed because of the reduced income. What seemed like a simple lifestyle decision turned out to be a powerful tax strategy. Charitable giving offers yet another path. Many retirees want to support causes they believe in, whether it's a local school, a food bank, or a community center. By directing IRA distributions straight to charities, retirees can fulfill their required minimum distributions without those amounts being counted as taxable income. It's one of those rare times where generosity and tax planning align perfectly. For those who value community support, this method delivers both financial and emotional rewards. Another subtle but effective approach is spreading withdrawals across multiple accounts. If you take everything from a traditional IRA, you increase taxable income. But if you balance withdrawals, some from Roth accounts, some from taxable accounts, some from municipal bonds, you control your taxable levels more carefully. This method requires planning, but it can mean the difference between paying tax on 85% of your Social Security or none at all. The heart of all these strategies is not avoidance for its own sake. It is protection. After decades of hard work, retirees deserve to keep more of what they earned. The United States tax system allows this, but only for those who take time to understand and apply its principles. Without planning, retirees like Michael and Robert find themselves surprised and disappointed. With planning, retirees like John and David experience security, freedom, and dignity. Retirement should not be a time of fear. It should be a time of fulfillment. Each decision, from the accounts you choose, the state you live in, the timing of your withdrawals, the way you give to charity, to even the size of your home shapes how much of your income you keep. Knowledge is the key, and those who seek it open doors that others never realize exist. Retirement planning in America is often compared to building a house. You need a solid foundation, careful design, and attention to detail. If one part is neglected, the whole structure can become unstable. In the same way, retirees who ignore the impact of taxes often find their financial house shaking just when they need stability most. Picture Thomas, a small business owner from Colorado. He spent his entire career running a family bakery. His retirement plan was simple: sell the business, live off the proceeds, and supplement with Social Security. But when he sold, he faced a massive capital gains tax bill. What he thought would be a golden windfall was suddenly reduced by almost a third. Thomas wished he had structured the sale differently, perhaps by spreading payments across years or using special retirement accounts. The lesson is clear. How you exit your career is just as important as how you lived it. This brings us to another strategy: spreading income sources across time. Imagine retiring in stages instead of all at once. Some people choose partial retirement, working part-time or consulting. This may sound like extra effort, but it also allows a smoother transition. By keeping earned income low, you delay heavy withdrawals from taxable accounts. Your Social Security remains lightly taxed or even tax-free, and your nest egg stretches further. The decision to phase into retirement rather than stop suddenly is both lifestyle and tax smart. Another important element is legacy planning. Many retirees wish to pass something on to their children or grandchildren, but without preparation, the tax burden on heirs can be overwhelming. Traditional retirement accounts left to heirs become taxable when they withdraw. Roth accounts, on the other hand, pass on tax-free benefits. By shifting assets while alive, you not only protect yourself but also ease the path for those you leave behind. Imagine the peace of mind knowing that your family will not face a heavy tax bill because you made careful decisions. Healthcare remains one of the most unpredictable expenses in retirement, and it often collides with taxation. Medicare premiums, for example, are tied to your income. If you keep taxable withdrawals low, you may qualify for lower Medicare costs. For retirees on a fixed budget, this can make a meaningful difference. An overlooked strategy is timing withdrawals to stay just under Medicare income thresholds. This requires coordination, but it pays dividends for years. Take the story of Arthur, a retired teacher from Michigan. At first, he withdrew large sums from his IRA, not realizing that doing so increased his Medicare premiums. When he consulted a planner, he adjusted. He began splitting withdrawals between Roth accounts and taxable savings, keeping his reported income lower. Within a year, his Medicare premiums dropped, giving him hundreds of extra dollars each month to spend on living expenses. His lesson was simple: taxes and healthcare are interconnected, and managing one helps manage the other. Downsizing expenses can also create hidden tax advantages. Suppose you sell a primary residence after many years. The tax code allows exclusions on capital gains up to $250,000 for individuals and $500,000 for couples if certain conditions are met. For retirees, this means a chance to unlock equity from a home without a crushing tax bill. Many have used this to shift from large houses into retirement communities, pocketing the difference tax-free. This isn't just about money, it's about freedom. It allows retirees to release themselves from the weight of maintenance and property costs, while keeping more of their gains intact. Consider William, a retired veteran from Oregon. He lived in the same house for 40 years. When he finally sold, the capital gains exclusion saved him nearly $200,000 in taxes. He moved into a smaller condo with lower expenses and more security. The money he kept gave him the freedom to travel, support his grandchildren's education, and live more comfortably than he ever imagined. Investment choices also shape retirement taxes. Not every investment is equal. Qualified dividends, long-term capital gains, and municipal bond interest often receive favorable tax treatment compared to ordinary income. Retirees who shift their portfolio toward tax-efficient investments discover that they can maintain the same lifestyle with less taxable income. It's not about taking risks, it's about being intentional. The stock market may seem daunting, but even modest adjustments like holding assets longer than a year to qualify for lower capital gains rates create significant advantages. There's also the role of annuities. While not suitable for everyone, some annuities allow a portion of distributions to be considered a return of principal rather than taxable income. For retirees seeking stability, this can create predictable cash flow while reducing taxes. The key is to choose wisely, since annuities vary greatly in cost and structure. Those who study carefully or consult trustworthy advisors find that certain annuities complement other retirement strategies, adding another layer of control. At the heart of all these decisions lies discipline. It's easy to think of retirement as a time of freedom from planning, but in reality, planning never ends. The choices you make in your 60s echo into your 70s and 80s. For example, converting to Roth accounts slowly each year requires patience, but rewards you with long-term relief. Spreading income sources takes organization, but saves thousands in taxes. Donating directly from IRA letters requires forethought, but fulfills both financial and personal goals. Each action is small, but together, they create a retirement that is not burdened by unnecessary taxation. What's remarkable is how often people fail to prepare, not because they don't care, but because they don't know. Financial literacy is not widely taught, and many Americans stumble into retirement, believing that savings alone will carry them through. But savings without strategy is like a ship without a compass. It drifts often into dangerous waters. Strategy, on the other hand, directs your journey, allowing you to arrive safely at your intended destination. Think about the dignity that comes with control. Imagine walking into a bank to withdraw from your Roth account, knowing that every dollar is yours to keep. Imagine moving into a tax-friendly state, enjoying sunshine and comfort, while your money lasts years longer than it would elsewhere. Imagine giving to causes you care about and watching your generosity ripple through the community, all while keeping your taxable income lower. These are not dreams. These are realities for those who take the time to understand and act. The difference between fear and freedom in retirement often comes down to knowledge. Two neighbors can live side by side, both with the same savings. Yet one struggles while the other thrives. The one who thrives is the one who took steps early. Balanced accounts. Consider geography, timed withdrawals, and diversified wisely. In America, the law itself allows for this, rewarding those who plan. It is not about avoiding responsibility. It is about fulfilling it in a way that also preserves dignity. For many, retirement is the first time in life when the clock slows down. The hustle of work fades, and mornings are quiet. But peace is only real when financial stress is absent. By applying these strategies, by thinking like Michael, Robert, John, David, William, and countless others, you give yourself the chance to live retirement as it should be lived, with security, with choice, with freedom.